Hi, I'm Tom Lydon with ETF Trends here in Washington, D.C. at the Charles Schwab Institutional Conference with Ed Rosenberg, head of ETFs for American Century. Great seeing you, Ed.
Great seeing you, Tom.
Now, you're an industry veteran. Listen, I'm not going to ask your age or anything like that, but we've been around for a while. We've seen a lot of flows, we've seen a lot of trends. What are some of the big things that you're seeing today that are getting you really excited?
So just look at this year, right? The biggest part, when you look at flows for this year, it's a tale of two stories. It's a tale before the trade wars and a tale after. A lot of money was going into domestic, and that has not changed throughout the entire year. A lot of money is still going into domestic equity ETFs. There was a huge trend early in the year to go to international. That dropped significantly and went negative, not for the year, but after April, there was a lot of outflows.
Yeah.
But there's also that trend in fixed income ETFs. Now what's interesting about both the domestic equity and fixed income, it's not just your basic simple products. It's alternatively weighted and some active in equity, which is new. The active space is picking up a little bit. And in the fixed income space, it's very much active. You're seeing a lot of flows go into the active ETF space.
So pure beta strategies, which really built the ETF industry, we're starting to see some changes going on. Why is that?
I think what you're seeing is people looking not just to replicate an index, but outperform.
Yeah.
Have some drivers and some ability to outperform. If you want to differentiate yourself from advisor A versus advisor B, how do you do that? Well, you can do it in the services you offer, but it can also be the products that you put into your portfolios to potentially generate more alpha for a client over the long term.
Yeah, we survey advisors all the time, and lately more have said they don't mind paying up for a more intelligent index as opposed to low-cost beta strategies.
And that's the point. Advisors are seeking out something that you can own that offers better products. Now, what's interesting about it is they're offering better products, but they're willing to do more research to understand how that product works, to see how it fits into the portfolio. So as you said with your survey, it's not just about price now, it's about what is that product trying to accomplish, and how does it go about accomplishing it to fit within what they're trying to do.
American Century, great long-term track record, one of the kings in the fund business. But now in the ETF space, how are you folks doing it differently?
So let's start off with what we're trying to do is people talk about factors or smart beta. We're not doing that. What we're doing is we're trying to capture the fundamental approach of what a true asset manager does and put it into an ETF format. And that format's been, so far in the equity space, been a systematic approach. We call it intelligent beta. Or there's been an active approach in the fixed income space. So for equities, it's the intelligent beta. For active, or for fixed income, I mean, it's going to be the active space. Because in reality, even if you have an index in the fixed income space, you can't replicate it. So there's a lot of active decisions going on.
Yeah.
This way you can take advantage of the portfolio manager's skill and really selecting the bonds, but also selecting the duration that goes with it.
So one of the new launches was a municipal bond. Tell us about that ETF strategy.
Absolutely, so it's unique in the space, right? It combines, what it's going to do is combine investment grade and high yield. And the purpose of it is to allow the portfolio managers to determine where the better value is, to create a better risk reward profile. When you combine investment grade and high yield, you tend to get a slightly shorter duration with a slightly higher yield. Now that's one aspect. The other thing we've done is we've given the portfolio managers a band of duration. So they can go between 3 and 10 years, depending on what they think yields are. And what they can do with that is, if they think yields are going to rise, they have the potential to shorten that duration, if they can get to it. Or if they think yields are going to fall, we can go longer. It's very different than an index because we've got a lot of levers we can pull to create that better risk-reward profile for the client.
And finally, what you're doing on the growth side, you have an approach that no one has tried to tackle yet.
Correct. So if you look at growth, there's the basic indexes. Let's leave those out for a second. Then you have the alternatively weighted. And when you're trying to talk about alternatively weighted, it centers around momentum. We're doing something completely different. We're trying to capture fundamental ideas, fundamental metrics that can lead towards a growth portfolio. And all of our portfolios on the index side are dynamic. They shift between one thing and the other. So our portfolio will shift between an aggressive growth portfolio and a GARP style portfolio.
Gotcha.
While capturing a quality overlay. And just to think about quality for a second, it's very different. Quality is not a factor. Quality is looking at the financials and determining if it's a good company and do you want to own it. And then building those two portfolios, the aggressive growth in the GARP portfolio and merging those together based on the fundamentals of a company. It's very unique in the space. It has never been tried before, never been accomplished. So we are the first with that product type out there.
Excellent. Well, Ed, as always, it's great seeing you. Thank you.
It's great seeing you. Thank you, Tom.